Let me just, since you asked me about the market, I just had a short 3-4 slide presentation, which I think should help contextualize the question which you asked. It's a slightly long answer, but I hope it will be useful for everybody. So Nifty, if you look at Nifty 50 currently, हमारा Nifty 50 का price earning ratio, PE as we call it, is roughly 19 times. And if you look at our 10-year average of Nifty 50, it typically trades at around 18 times. So we are trading around at a 5% premium of the 10-year average. So it had moved up to as high as 24 times. It's corrected from there. And right now, even today, it trades at around a 5% premium. The premium valuation that we had has come off, like I mentioned. And these reasons are known to you. I'm not going to say anything new. The concern generally across the markets has been, of course, the expected rise in yields. And kal raat ko, I'm sure all of you must have read that Fed has increased their rates by 25 basis points, as has been expected. But basically what it is doing is it is now confirming that US may rates will keep going up during the rest of the year. So last night was, of course, the first such move, and there'll be 6 more moves expectedly during the course of this year. And of course, the second concern generally globally and more so for India has been with respect to the higher crude prices. Like I said, both these reasons are known to you. There's nothing new that I'm saying, but that has caused the premium valuation to decline. But still we are at a premium to our 10-year average. I think that is more important for all of you to note. Thirdly, in the context of where we are, how are we thinking about the Indian markets? Hamara kya sochna hai? And Hamara, at least what is visible to us, this is how we look at the market and the conversations we've been having with various constituents, which is including the companies where we are invested. We think it's going to be a pull and push this year between generally good economic growth for the country, for India, thereby represented by good earnings growth in many companies, versus higher interest rates. The reason I'm saying this is because typically when rates go up, you will find that equity valuations tend to moderate. So that calibration we think will happen during this year. So you will have one scenario of rates going up and another scenario where while earnings will be good and positive, you will have that pull and push this year as the moderation takes place. So even if the multiples ease, even if you think that earnings are good and hence valuations have become from a multiples perspective more conducive, we think that you will have a year which is fairly moderate from the point of view of what we have experienced. Last 2 saal mein, as all of you know, we've experienced very, very healthy returns. Compared to that, we think the year will be likely to be positive on equity, but the returns will be moderate in context of what's happening globally. This is, I think, an interesting slide, which might just contextualize jo maine abhi bataya. What this slide is doing is it's showing you it's basically showing you over the last 13 years, how is our Nifty valuation vis-a-vis the emerging markets valuation. So, jo average hai, Nifty typically trades at around 40% to the emerging market valuation. So Nifty always trades at a premium. That longer term average is around 40%. And what you can see in this graph is we are currently trading at quite a bit of a premium to that average. So roughly we are trading at a 70% premium. So it is much higher than where we have traded, and this graph really depicts that very simply. Having said which, our belief is that generally EMs and specifically Asian emerging markets have got very, very healthy balance sheets. I'm talking about the governmental balance sheets, and they are quite healthy. So Thereby, our expectation is that these economies in general should continue to do well and find favor, which means emerging markets generally should do well, and within that, the Asian EMs, given the stronger balance sheets, should do better. And hence, India consequently should also move in line with how EMs are moving. So while we are trading at a premium, we think that we may continue to trade at a premium, provided our the vulnerability to oil etc is not in question. So if oil sustains at 100 plus, then this premium is substantially going to come off. But if, let's say, everything else, ceteris paribus, everything else remaining the same, if oil comes back to where it was trading, say around 75 or 70, we may continue to sort of trade at a premium. But the big thing in question is oil. And as you can see, the reason I'm making this case is you see we are trading at a premium to our own longer term average. This is also one interesting perspective which I thought you may like, is this is telling you how is our mid cap valuation. And the reason I'm sharing this with you is generally our belief is that as the economy recovers, and the recovery in our expectation is going to be fairly broad based, thereby the expectation is that you will have the market remaining broad based, and thereby many more companies from the small and mid cap space doing well. So while I have told you in my earlier two slides that the Nifty is trading at a premium, and thereby carries a certain amount of cap on the potential return, our belief is that the small and mid cap probably represents a better risk reward ratio. So we generally find that there are many companies in the mid cap space where the leverage is quite low. And given that the leverage is quite low, earnings visibility is better. We think that the potential of surprises on the upside may be visible in the small and mid cap space in this financial year, and that thereby we remain very, very constructive or positively oriented towards this space in general. I also thought maybe lastly I'll give you some sectoral view in the context of how we see things. हमारा view है that these sectors we remain fairly positive or constructive. We think banking remains reasonably valued. We don't think you have banking trades at a very, very expensive valuation. In fact, the correction we have witnessed in banking over the last couple of months has only made it that much more attractive, probably. So our belief is the balance sheets are very, very strong. They are adequately capitalized. They have enough capital for growth. The loss ratios or the credit provisioning that they have to do is at multi-year lows. So we remain very, very positive inclined towards banking. We think the second sector, which is capital goods and manufacturing, is probably is looking the most attractive. We have not seen in last many years this sector looking as attractive as we happen to feel it is today. And when we talk to companies, we get an indication that the order books are at significantly higher levels than the companies themselves have experienced in the past few years. So we are very, very positive about capital goods as a segment. We continue to be positive on digital. We obviously have seen phenomenal demand growth from this segment. And our belief is that even in terms of margins, we remain very positively sort of inclined on what this segment can provide in this year. One segment which is again, very clearly on a path of recovery where we feel valuations continue to be attractive is real estate. And that's another sector that we have a positive view on. Healthcare is a sector where we are positive, and here I'm referring to healthcare, which is not, our traditional pharmaceutical sort of manufacturing business. This is a very broad segment of healthcare, which includes hospitals or path labs, etc., etc. We think that's a sector which is going to give us, substantially significant upside in the next few years. So we remain positive on that. And I think telecom in general, while there are not many players in this sector, but we're positive on telecom also. So these are the 6 sectors in the context of what I spoke on the markets. We remain positively inclined on. Anand, I hope that sort of put things in perspective.
Yeah. Thank you. Thanks for giving such a great insight on the markets and the Nifty PE premium, all those things. So the basic question there was in my mind that as the volatility is there in the market, and as you very well mentioned as well, that current year one may only garner moderate returns in during this calendar year or the financial year. Moderate returns are going to be generated for equity investors, and the scenario for debt as well is not looking good because the interest rates are on the uptrend. So which asset class our channel partners should suggest to their clients?
Yeah, I think there are not too many asset classes if you think of capital appreciation from a 2 to 3 year perspective. So I think equities as an asset class from a capital appreciation perspective will continue to sort of remain attractive. I think the reason of probably being a little circumspect about equity is you had 2 years of very, very strong growth. And, I think it's just that we tend to extrapolate recent past for the future. And which is why I made the point that equities may probably be having a moderate return. It's not that equities as an asset class should be re-questioned. I think the potential appreciation, given that the economy is doing well, given that we see several companies doing well, we believe equities as an asset class will continue to sort of find scope for appreciation from a 2 to 3 year perspective. So I don't think that view changes really.
Okay. So as if we talk about the market movements during last 2 months, especially, then we have seen that the market touched the all-time high, then fizzled down to 16,200. Now it's moving towards 17,100 or 200. So during this volatility within the gap of 30-40 trading days session, so we are keep on getting the queries from the investors that how they can manage this thing, the volatility of the market. Either they should stay invested or come out, and once the market is going to be stabilized, then reinvest the amount. What's your suggestion to our investors through our channel partners?
Yeah, I think for somebody who's investing with a 2 3 year horizon, and I'm not saying 5 years and 10 years, I'm saying even in the medium term horizon, my belief, like I said, is that equities continues to be a favored asset class. And the challenge with equities, as all of you know, and I'm sure everybody on the call understands, is that you cannot potentially time it. So it's almost impossible to say, now it's 18,000, it's going to go down to 16, hence cash out, and, we will re-enter at 16. Nobody knows that. I don't know that definitely. So to that extent, I think if somebody's allocated money to equity, I think you have to stay the course and, await, the duration in this asset class, rather than try to get, rather than try to believe that you can time and know when to get out, when to get in. Like I said, I don't think we have the ability to say that. And so I would say that the asset class is right if you have the right duration in mind.
So how much should be the minimum duration one should keep in mind before investing or while investing in equities?
I think there is no right answer to this question, very honestly. Many times you will find stocks run up very quickly, and there will be many years where stocks do nothing. I think the right way to think about equity is you have to follow the earnings in the economy, and if you believe that the earnings visibility and momentum is good, then you should sort of sustain the stay as far as you can. Then whether it is 2 years, 3 years, 4 years is anybody's guess. I think that's the indicator I would give a lot of weightage to determine whether you should stay in equities or not stay in equities. I don't think, traditionally we say that think long term and 3 to 5 years and etc. etc. But there have been periods where you may have invested and 3 years later, let's say if you invested in March 18, for example, and
Hmm,
COVID
hmm,
happened, your investment may not have looked good after a 3 year period. And I'm
hmm.
sure there are advisors on this call who would have been questioned saying 3 साल बोला था आपने but अभी तो सब negative हो गया. Who could have said COVID होगा? But
Agreed.
I think the question is, as far as you know, आपके earnings momentum is good. That gives you that much more comfort, because if markets fall, your margin of safety goes up. And hence, I wouldn't equate duration. I would just say that as far as you know that the earnings momentum generally in economy and in your portfolio is good, you should stay the course.
So as you mentioned, it's very hard to time the market at each and every point or at each and every level. Then don't you think so that if there's a major importance of asset allocation to the portfolios there? That So I request you to please help us to understand the importance of proper asset allocation, and while creating a portfolio, what things our channel partner should keep in mind while creating a doing a proper asset allocation for our investors. Please throw some light on it.
So, Anand, and मैं ये सबको कह रहा हूँ, I have actually worked on your side of the table for my longest part of my career, and I can tell you out of personal experience that the right asset allocation is easier to design. The challenge which an advisor has is that you are often not privy to the investor's total investment portfolio. And hence, the right answer is that when you have conversations, you want to have an asset allocation conversation, but you only have visibility of a part of the overall assets of an investor, which makes the job that much more challenging. Having said which, with the limited information that you may have, I think the only manner in which asset allocation can get derived is by really determining how much is the investable surplus which an individual has, which genuinely has a longer duration. And to that extent, I think while typically as a rule of thumb, you do asset allocation basis age and then determine how much should go into equity. But realistically speaking, I think if the investable assets that the individual has a longer duration, those can be parked in equity, and you may keep around 10 to 15% as emergency funds is the way I think about it. So I think if you got $100 to invest, and like I said, if the view is that you don't need it, these are investable surpluses, I would say a significant part of it, up to 80-85%, can be allocated, and then the balance is what should be kept towards emergency funds, and then which of course can be in various asset classes. It could be, depending on your risk appetite, it could be in higher yielding coupon or credit risk funds, or safer funds, or you could have an allocation towards gold. The only other additional information is that I think increasingly it's becoming important when you think asset allocation. Traditionally, all of us have thought of asset allocation as equity, debt, gold, typically. I think two additional sort of cuts from an asset allocation perspective we need to bear in mind is, I think increasingly it's becoming important to have an international exposure. So, within that, you may say a certain part of your equity exposure say up to 10% can be kept towards your international
Agree.
assets. And the fifth part is really, I think, increasingly there are many other commodities which are now available to investors via mutual funds. Be it outside of gold. I mean, you have all kinds of commodities which now exposure is being made available. And I think investors should sort of keep that consideration in mind.
Yeah, I
So I just
completely.
think that the basket has been very, very broad, become very broad based in the last few years as compared to what we have witnessed over the past couple of decades.
So asset allocation, I think, according to you as well, that it totally dependent upon the investment goal altogether. That when the liquidity or the target, what the target is basically, investment goal is, what the defined goal is of the investor.
Yes,
So
yes,
according to that, one can allocate the percentage to different assets.
yes.
Oh, that's great. So, which category, if somebody is a new investor or wants to invest in equity, then according to the current market scenario, Mr. Bhobe, what's your guidance to him? Either he should invest through mutual funds or mutual funds, sorry, in mutual funds via in a lump sum mode or through SIP mode. There's a high disconnect in within the community as well, that which one is a better mode to invest, SIP or a lump sum, if an investor has a long term horizon.
See, I think irrespective of your time horizon, the best way to invest in equities is invest in a staggered manner. I don't think that should be the consideration. I think the consideration should be that if you have $100 to invest,
Mm.
should you invest it over a fairly long period of time or a sort of medium period of time? So I am not a big advocate of lump sum. While lump sum is a way to invest, nothing wrong with it. I generally would recommend that invest in a staggered manner over a period of time. Now, whether that period of time is 3 months or 6 months is can be decided. But I think it's just that spreading your date of investments is a far more prudent thing to do, given that we always say we can't time the market, we don't know the point of entry, we don't know the point of exit for that matter. So which is why I said I think the better route is to do it in a staggered manner. SIP is a separate conversation because SIP you're talking about building a habit of towards investing,
Yes,
where
yes.
you're saying I will keep investing over a fairly long period of time. So that's a
With a
separate
disciplined approach.
conversation in a
With a
disciplined
discipline,
approach.
yes.
That's right. That's right.
So, do you consider that SIP is a better manner for the retail investors to invest as compared to the this lump sum one?
It's not only a better manner. I think every investor should have a SIP in the first place, right? I mean, you may have investable surpluses. So take examples of salaried individuals who get bonuses, or
Hmm.
even business self-employed professionals who might get a large quantum for an order execution and so on. So those might get deployed from a lump sum manner in a lump sum manner in a shorter period of time. But there should be an investing habit as a discipline which should get institutionalized, and that happens with a SIP. So to my mind, that's why I said these are two separate conversations. So it's not that because you do a SIP you shouldn't do a lump sum, or vice versa.
Hmm. I completely agree with your point. So, which category within the mutual fund do you think is suitable for the investor in all kinds of market scenarios?
Yeah, I think yeah, if you really look at the categories, and now there are multiple categories, as you know, besides sectoral funds. Sectoral funds
Yes,
itself
yes.
is another way to think about investing. But I think the best category, if for an investor who wants to invest for a long term, would be your funds which give an exposure to everything, which is where your funds like a multi-cap fund or a large and a mid-cap fund for that matter, which will have a large cap exposure, mid-cap exposure, small cap exposure, in various combinations, is really a good bet, coupled with the fact that you could think of hybrid funds as another sort of combination. Because I think the variety in hybrid funds today, which is made available by way of the traditional hybrid fund, BAF, multi-asset funds, and so on, really has made investing for an investor that much more simpler than what it was a few years ago. And I think these are good categories, proven categories, and I think there is no reason an investor will feel disappointed. I think the choice he has to make is how much risk is he willing to take. I mean, if he wants a lower risk, then relatively hybrid category is better. If he wants a higher risk, then any diversified category is better. But rather than only think of a mid cap fund or a large cap fund or a small cap fund, I typically think a multi cap or a large and a mid cap or a for flexi cap for that matter. I'm just saying those categories have the ability to mix things around far better from an investor perspective.
So within the equity space, just wanted to know that what do you think, whether a flexi cap is a better bet for the retail investor or any of the thematic funds? I know that these are two separate things, but I just wanted to know on behalf of my channel partners that whether to go ahead with the thematic fund or a flexi cap, because flexi cap, if the fund manager has the vision that this particular theme is going to play, then he has a liberty to jump into that theme. So which is the good part over here? Just wanted to know whether the investor should invest in the thematic fund or give opportunity to the flexi cap fund manager to jump on the particular theme.
Yeah, I think my view is for a layman, as in a lay investor who has
Yes.
very little understanding of equities in general and sectors in particular. I think diversified equity funds are a better bet, whether it is large and mid cap, flexi cap, multi cap, anything. I think sectoral funds are meant for investors or for advisors who advise investors on a particular sector with higher conviction on why a particular sector is going to do well, and hence you are investing in a sectoral fund. I mean, sectoral funds, as you know, take fairly concentrated bets on stocks within that sector. So you have a
Yes.
higher degree of concentration, which means a higher degree of risk. So you have a two-level risk which you take in a sectoral fund. One is you're taking a bet on a particular sector and you're assuming the sector will do better than the market. That's the first level of risk. The second level of risk is that inherently they take higher allocations to those stocks and hence have a higher sort of risk which you carry because it's a
Yes.
concentrated portfolio. So if actually the call goes right, you will make far higher amount of money than the other diversified equity funds, and you can pat yourself on the back for the advice or for the investment. But if the call doesn't go right, then you have to stand by the decision you made. And that's why I said it is for evolved investors where you know why you did what you did. Whereas with a diversified equity fund, that's not the case, right? You just said that I want to put my money in the equity markets. You're believing the fund manager will sort of create a diversified portfolio of the right companies and so on. So I think these are very. I would say that sectoral funds should be very for evolved investors or under advisement.
Okay, so according to you, one should go ahead with the flexi or diversified first, and if the
That's right.
risk profile allows, and the investor has the conviction for the particular theme or a sector, then they should go ahead for that.
That's right.
Okay, okay, thank you. That's it. The questions I had. So we can start asking queries from the we can go through the queries from our audience as well. So we have first
Sure.
query, Mr. Bobby, from Rohit Gupta, one of our audience. He said that can we know how much premium Nifty and small cap, mid cap, if not specified, then till tentative.
I didn't get the question, Anand. How much premium
Uh,
does small cap, mid cap have? Is that the question?
yeah. Yes.
So mid caps, like I showed in my chart earlier, are not trading. So if I look at the 10-year average, like I showed in one of my charts, you'll find mid caps today are trading at the longer term average. They are at a premium, but they're trading at a longer term average, and which is why I said that as the economy we expect is going to get broad based this year, there are going to be lots of companies in the small and mid cap space which should offer a better risk return reward in this financial year, at least in our view. So that's quite attractively priced at this point of time.
Okay. Okay. So next question we have, Mr. Bhobe, from our audience, Vishal. He needs to know that how the Fed rate hike is going to impact our markets. Today, the markets were positive despite the rate hikes. Will we see the same stance in future also if the rates are going to hike again?
So I think, Vishal, if you followed the markets, which I'm sure you have for a long time, just compare what is happening now with what happened in 2013. If you recall this term which media coined of taper tantrum, what was that about? That was about Fed withdrawing liquidity in 2013, and that's when currencies in general crashed. Rupee was in a terrible state then, and our forex reserves were substantially lower, of course. But why did that happen at that point of time? The reason why that happened is the market wasn't adequately prepared. Whereas if you recollect what has been happening now over the past several months, I think Fed has been actively communicating to the market about what they intend doing. I think they've been saying inflation's on the higher side. They've indicated to the market they have withdrawn liquidity in the last 4 months. They've stopped buying the papers they used to in the last 4 months, and now the last thing pending was that rates will go up. So this time around, what has happened is they have been communicating aggressively to try and manage the market's expectation. So partly the reason why the market probably did not react adversely despite the rates going up is it's something which the market's been expecting. So there was no surprise really when they hiked the rates by 25 basis points. But had the Fed hiked rates by 50 basis points or higher, your market would have been surprised because that's not expected. So I think to the credit, they've been giving enough notice कि हम ये करने वाले हैं. And which is why to that extent all of us know that it's happening. To your point on what impact will it have over the coming year, like I presented in my first slide, it is expected that generally rates will head up in the US, in India, in several economies around the world. And like I said, higher rates is not a positive. I mean, you're typically, as rates move up, your valuations sort of tend to get, the premium discounting that you were getting at low rates will sort of substantially reduce. So to that extent, you will have that pull and pressure, pull and push during this year in equities. And which is why I said in the context of India, given that we're trading at a premium, it's essential that our macros, which get disturbed because of oil, should hopefully, if oil comes down, we will be in a relatively better shape. If oil stays at relatively high levels, that will impact India adversely. And to that extent, if rates keep going up, as is expected, which could mean higher withdrawal of liquidity from the country, thereby impacting the flows in the market. So that's really the impact as far as we are concerned. So which is why I think this thing is a very, very watched event.
Okay, okay. So Vishal has another question as well. He just wanted to know the view on gold, and as a part of asset allocation, how much one should go for gold in his portfolio.
Sure. So I think the view on gold really emanates from these macros that I talked about. So if an event like a war were to happen and continue, or if the whole dollar trade sort of, if there is debasing of that, is when commodities like gold typically get into favor. So should gold be a part of an asset allocation? I think gold should be a part of an asset allocation. Gold is an important commodity. Like I said, there are several macro factors which sort of create demand for it. And I think in the current environment where, I mean, if you saw what happened to Russia, where their forex reserves have sort of been not being made available to them because they're in some other country, etc., is only increasing the case for maybe commodities such as gold. So several macro factors will impact it, and I think there should be an asset allocation towards gold that an investor should have. Just that, given that the returns in gold are not very straight line, there'll be returns. Many years gold doesn't do anything, and then some event happen, gold moves up quickly or goes down quickly. Either ways, I think your allocation should be nominal. I don't think you should have a significant two-digit allocation. You typically could have a 7 to 10% allocation in gold. Like I said, it should be a meaningful allocation, but not a significant allocation.
I completely agree with your point, Mr. Bhobe, that it's a non-productive asset altogether, but it's a safe haven bet as well. So one should not have more than 10% allocation to the in his portfolio, either in an aggressive portfolio as well or a conservative as well. So we have another query from question from Mr. Abhay Bora. He wants to know your view on other asset classes. Out of other, we have already covered two asset classes, gold and equity. So we wish to know about debt as well, like the scenario of the central banks across the globe. They are keep on going to rise the interest rates if we talk about any of the geography. So where one should invest in debt within the debt space, either a short-term bond funds, short-term funds, or a long-term duration is a good bet. So which category one should go ahead with?
See, I think as all of us understand, when the rates are headed up, your longer term bonds typically tend to get impacted because of the adverse valuations, and your portfolios don't look good. I think the right way to think about this question is that, is this money being allocated for a particular purpose and without any, I mean, if you want a certainty with what return to expect, then I think debt is okay at any level, because you know what return you'll make. Basically, you know the coupons, and hence you know what you'll make over the period of time. The challenge is that if you're saying, I just want to park money in debt and I don't know whether I will get out of it 1 year down the line or 1.5 year down the line and so on, and then if you are in a rising rate cycle, then you may practically, your returns to that extent go down depending on how much rates move up. So if your view on rates is that rates are going to move up and your monies that you're investing are for 6 months, 1 year, and so on, then it is better to be at the shorter end. So then it is better in any ultra category, whether it is the low duration or ultra short, or a money market fund. So it's better to be at the shorter end of the curve. To that extent, you don't carry as much risk with respect to rates, even if the rates are moving up. Whereas if you are in a short bond or a cop bond, etc., where the maturities or the average mods are say 2.5 years or thereabout, if there is a rate move upwards, you will see an impact on your portfolio. So I think it really depends on the investor. I mean, even today there are investors who will say, I'm happy with a 5.5% return, and as far as so they'll invest in very, very long term, sort of 7-year portfolios, etc. Like a combination of SDLs and CPs and so on, which they know how much they'll make over that period of time, but they're willing to stay put. But if you're not going to stay put, then you are better off being at the shorter end in a rising rate scenario.
Agreed. It's makes sense as well, given the current scenario. One should maintain themselves with the ultra short term or short term bond fund. But there's one query which I wish to know from you. What's your view on floating rate funds with ultra short term funds?
See, I think floating rate funds are good places in a rising rate scenario.
Yes, that's why.
So from that perspective, they are good places to be in. It's just that floating rate funds have a challenge that in India, you don't have too many issuances of floating rate paper.
Oh, Okay.
So to that extent, the way we manage floating rate funds is, so we'll have a combination of floating rate paper and, swaps that we do. So it's a
Okay.
combination of both.
Okay.
Not that it makes a difference to the investor, but I'm just saying that you should know that floating rate in a normal debt paper, you'll have fixed term paper which you would have bought and you would have sat on it. Whereas here it will be a combination of both
Okay.
in a floating
Okay.
rate paper. But otherwise, in a rising rate scenario, it's a better place to be in than in a slightly longer term debt paper.
Yes. 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 Thank you. So next query we have Mr. Bhobe from Manish Kumar. He just want to know what would be the best strategy for investing. Should we invest in certain sectors which has declined substantially, or in sector which is growing substantially?
So I assume he's asking more in the context of sectoral funds
Yes,
necessarily,
yes, yes, yes.
because otherwise my answer would be that if you go to a flexi or a multi-cap fund, then anyway it's doing investing across. So if the question is out of the sectoral funds, should you invest in a sector which has fallen more or rising more, if that's the question. That's a tough question to answer, but I think I would say like this, that what I mentioned earlier, that sectoral funds are for evolved investors, are for investors who are advised by advisors basis why they are saying what they're saying. I don't think it is about because the sector has fallen more, it becomes more attractive necessarily. I mean, if you recollect, in 2007-8, there were so many infrastructure funds which came out at that point of time. Not that those funds were not well managed; it's just that infrastructure companies itself did not do well for so many years. So having invested in an infrastructure fund, if the fund would have fallen over a period of time, it would have probably fallen more because the companies did not do well. So I think there is no right answer to say fallen fund will do better than a rising fund. I think it's really a matter of deciding the view basis the sector you're talking about, and knowing why the sector should do well basis whatever the macros are for that sector, really.
Thank you, Mr. Bhobe. So just wanted to know, Suruchi, do we have any further questions?
So I guess there are no more questions. And so everybody, that was Mr. Prathit Bhobe, CEO and Managing Director of Tata Asset Management Private Limited with us. Thank you so much, Mr. Prathit, for joining and sharing
Thank
your
you, having me.
expertise and wonderful thoughts with our audience today.
Thank you. Thank you
Prathit.
for having me.
Yeah.
Thank you.
Thank you.
And
Thank you.
Mr. Anand for providing us your valuable time.
No issues.
Thank you.
Thank you, and
Thank
happy
you.
Holi to everybody.
Happy Holi to you as well, Mr. Bhobe. Thank you.
Thank you. Bye-bye.
Bye. Happy Holi to everybody.
थैंक यू. सो आज के इवेंट में इतना ही, और सभी पार्टिसिपेंट्स का इस इवेंट का हिस्सा बनने के लिए धन्यवाद. इस सेशन की रिकॉर्डिंग आप सभी के साथ जल्द ही शेयर की जाएगी. एंड विश यू ऑल अ वेरी हैप्पी होली फ्रॉम टीम निवेश. थैंक यू एवरीवन फॉर कनेक्टिंग.